Insolvency, question number 1, first say. X, Y and Z, who are equal partners, decided to dissolve their firm. The following is their balance sheet after the sale of the assets. X capital 5,400, Y's capital 3,600, cash 4,500, Z capital overdrawn 1,800, realization 2,700. This is realization loss directly given. So the total of the balance sheet is 9,000 rupees and 9,000 rupees. Okay. Z become insolvent and couldn't pay anything to firm. Prepare the necessary ledger account to close the books of the firm. There was no agreement among the partners. This is the question. You are asked to prepare necessary ledger account and here Z becomes insolvent. Okay. What is given in the problem? Partner's name X, Y, Z. Profit sharing ratio 1:1:1. Insolvent partner name is Z. His contribution from his private estate is nil. Solvent partner name X and Y. Realization loss given in the balance sheet is 2,700 rupees. In this problem, we can directly prepare capital account of the partners because realization account net result is already shown in the balance sheet. Okay. So by balance, the balance of X is 5,400, Y is 3,600. To balance, Z has debit balance, that is 1,800 rupees. Then realization loss given in the balance sheet is 2,700. That 2,700 should be shared between all the partners in the ratio of 1:1:1. So 900 rupees, 900 rupees, 900 rupees. But the first we have to transfer the realization loss to their capital account. Okay. So there are two realization loss. X account is debited to 900 rupees. Y account is debited to 900 rupees. Z account is debited to 900 rupees. We have to apply Garner versus Moray rule because Z is insolvent. So according to Garner versus Moray rule, solvent partner should bring the cash equivalent to the share of their realization loss. Okay. Here the solvent partner are X and Y. Their share of realization loss is 900 rupees and 900 rupees. So they have to bring back. But Z cannot bring anything because he doesn't get any amount from his private assets. His contribution to the firm is nil. Already it is given in the problem. So we have to credit 900 rupees and 900 rupees to X capital and Y capital. They bring cash. So cash account debtor to capital account. Okay. So X capital account debtor to cash account 900. Y's capital account debtor to cash account 900 rupees. So their capital account is credited to the extent of 900 rupees. Then we have to find out now the deficiency of the Z capital account. Z capital account total is already he has a debit balance, that is 1,800 rupees. Realization loss is 900 rupees. Total is 2,700 rupees. So 2,700 rupees is his deficiency. This deficiency should be shared between X and Y in their then capital ratio. Okay, that is capital which stands in their in the firm before dissolution. Okay, or before realization. Okay, before realization, the capital of X is 5,400 rupees, Y is 3,600 rupees. If we simplify, we will get the ratio is 3:2. That 3:2 should be used to bear the loss of the insolvent partner or insolvent partner deficiency amount. Okay, the deficiency is how much? 2,700. So 2,700 should be borne by or should be accepted by X is 2,700 into 3/5. Y is 2,700 into 2 by 5. So 2,700 into 3 by 5 is equal to how much? 1,620. 2,700 into 2 by 5 is 1,080. The journal entry is solvent partner capital account debtor to insolvent partner capital account. X capital account debtor to Z capital account. The share of X is the loss which is bad by X is 1,620 and Y is 1,080. Y is capital account debtor to Z 1,080. Here the Z capital account is credited by, that is X capital account debtor to Z by X capital account 1,620 by Y's capital account is 1,080. So the total is tallied. Z capital account is closed. Okay. Then we have to find out the balance of X and Y. X total is 5,400 plus 900, that is 6,300. Here Y's total is 3,600 plus 900, 4,500. So 6,300. From this 6,300, realization loss is 900. X capital account deficiency he bears 1,620. So if we deduct, the balance is 3,780. That has to be paid by the firm to X. And then Y's capital account is 4,500 rupees. 4,500, from 4,500 we have to deduct 900 and 1,080. So the balance is 2,520. So the firm has to settle X 3,780, Y 2,520. Okay, this is the way to prepare capital account. Here the loss or deficiency treatment should be highlighted with red color. Okay. Next step we have to prepare cash account. Balance is 4,500, that is given in the balance sheet. Bank account debtor to X capital account. X and Y brings realization cash for their realization loss, share of realization loss, that is 900. Then total cash available is 6,300. Out of this 6,300, the cash which X reserve is 3,780, Y reserve is 2,520. So the total of the cash account is 6,300. So first step we have to prepare realization account. Second step we have to prepare capital account of the partners. Capital account of the partners. Third step we have to find out from that capital account, we can find out insolvent partner deficiency. Fourth step, that a deficiency should be shared between solvent partner, the then capital ratio. So according to the then capital ratio, that means before the realization or at the time of realization, what is their capital, that should be taken into consideration. Then fifth step, we have to prepare whether the how much amount should be given to or should be settled to the solvent partners. Okay, solvent partners balance in the capital account. Then the next last step, we have to prepare the cash account. Naturally, the cash account will be tallied. In this way, we have to close all the books under the insolvency of the partners. Okay. I hope you remember all the concepts and you understand all the concepts of the accounting treatment of insolvency of partners. If one or two partners or more partners are insolvent, we can follow this Garner versus Moray rule. If all the partners become insolvent, we cannot follow the Garner versus Moray rule. Question number 2. Ram, Robert and Raghu, who are partners, sharing profit and losses equally, agreed to dissolve the firm from 1193. On the date, their balance sheet was as under. Capital account, Ram 96,000, Robert 64,000, sundry creditors 40,000, sundry assets 1,68,000, P&L account 24,000, Raghu's capital account 8,000. So the total of the balance sheet is 2 lakhs. The assets realized 1,24,000. Expenses of realization amount to rupees 4,000. Raghu became insolvent and his estate paid rupees 3,200. Close the books of the firm when capitals are fluctuating. They are following fluctuating capital method. Assets realized is 1,24,000. P&L account is given in the asset side. Then expenses of realization is 4,000 rupees. Raghu is an insolvent partner. He brings cash to the extent of 3,200. Then first we have to prepare realization account. Realization account data to sundry assets is 1,68,000. Then assets realized is how much? 1,24,000, that is given in the problem. Then bank expenses to bank, that is realization expenses is given, that is 4,000 rupees. Liability by sundry creditors 40,000. Then they have to settle the sundry creditors. So if nothing is mentioned, 2% discount they are received, firm is received, 3% discount firm is received from sundry creditors. Like that sometimes we have seen. If no information is given about the sundry creditors settlement, or if the problem is silent about the settlement of the sundry creditors, then we have to understand that, we have to assume that the sundry creditors are settled as it is. Okay, so their balance is 40,000. The firm settles fully 40,000 rupees they settled. So the difference is, the total of the debit side is 2,12,000 rupees and the credit side is 1,64,000. So in this problem, the firm suffers a loss of 48,000 rupees. That 48,000 rupees should be shared between all the partners, that is Ram, Robert and Raghu, in the ratio of 1 is to profit sharing ratio, 1 is to 1 is to 1. See, the part of the realization loss of Ram is 16,000 rupees, Robert is 16,000 rupees and Raghu is 16,000 rupees. So we have written here, realization loss transferred to Ram's capital is 16,000. Robert capital is 16,000. Raghu's capital is 60,000. So first we transfer the assets, sundry assets, then we transfer the sundry liabilities, and then we realize the assets, and then we met the expenses. We have passed the entries for expenses, and then the firm settled the sundry creditors. The balance amount we have seen. So in this case, the firm faced loss that should be transferred to partners' capital account in their profit sharing ratio. Next step, we have to prepare the capital account of the partners by balance. Balance that is given in the balance sheet. Okay, by balance. Ram 96,000, Robert 64,000, Raghu has debit balance of 8,000 rupees. Then we have to transfer the realization loss. The share of realization loss of each partner is 16,000, 16,000, 16,000. That should be debited to their capital account. Ram capital account is debited 16,000. Robert capital account is debited to realization loss is 16,000. Raghu's capital account is debited 16,000 rupees. Then the next concept is, first here we apply because Raghu becomes insolvent. Okay, and so we are going to apply Garner versus Moray rule. According to Garner versus Moray rule, the solvent partner should bring cash equivalent to their share of loss, realization loss. Here the solvent partners are Ram and Robert, and so they have to bring equivalent to their share of loss, realization loss, that is 16,000. So here we write, we entered by bank, okay, cash account debtor to partners capital account, okay, they bring cash. Ram brings 16,000 rupees, Robert brings 16,000 rupees. Raghu is an insolvent. He brings only 3,200. His contribution from his private estate is 3,200 rupees. Okay. This is the first concept of rule of Gardner versus Moray. Okay. If he doesn't have any private assets, if he doesn't bring any cash, that is also acceptable one, because he is an insolvent partner. In this problem, he brings 3,200 rupees from his private assets. Okay. Then we have to pass journal entries for P&L account, capital account debtor to P&L account. Okay, because it stands under the asset side, 24,000. So that should be debited to all the partners capital account in their profit sharing ratio 1:1:1. So 8,000, 8,000, 8,000. Then we have to find out the deficiency of the insolvent partner. The deficiency of Raghu is 32,000 minus 3,200. That is 28,800. 32,000 is the debit side balance. Here he brings 3,200. So from 32,000, if we deduct 3,200, we will get 28,800 rupees. Okay. First step, we should calculate the deficiency of the insolvent partner. The deficiency of the insolvent partner is 28,800. That should be acceptable, or that should be borne by the solvent partners, in their then capital ratio. In this problem, the capital ratio of Ram and Robert is 11:7. Okay, that is at the time of dissolution. The capital stands in their account is to be taken for calculating the capital ratio. Okay, let's see how we arrive 11:7. Capital in the beginning is 96,000. We have to deduct P&L account. Profit and loss account is 8,000. Okay, this is a loss because it is given under the asset side. If we deduct, we will get 88,000, 56,000. So the ratio between 88 and 56 is 11:7. So the then capital ratio of solvent partner Ram and Robert is 11:7. So the deficiency of Raghu's capital account should be shared between Ram and Robert and their capital ratio, that is 11:7. So 28,800 Ram's capital, the entry is solvent partner's capital account debtor to insolvent partner capital account. So Ram's capital account debtor to Robert capital, Ram's capital account debtor, Robert capital account debtor to Raghu's capital account. So 28,800 into 11/18 is 17,600. Then 28,800 into 7/18 is 11,200. So the Ram has to bear 17,600. Robert has to bear 11,200. The deficiency of Raghu is 28,800. So the entry is solvent partner's capital account debtor to insolvent partner capital account. The Ram's capital account data to Raghu's capital account is 17,600. Robert capital account data to Raghu's capital account is 11,200. Then by Ram's capital, that is the Ram's capital account data, Raghu's capital account data to Robert capital account data to Raghu's capital account. So by Ram's capital is 17, under the Raghu we have to write, we have to enter the amount 17,600. Under the Raghu, Robert's capital account is 11,200. So his capital account is closed. Okay. Here we have 32,000. Here we have the deficiency of 28,800. That deficiency is shared between the solvent partner Ram and Robert. So his capital account is closed. Then we have to see the solvent partner's capital position. The solvent partner capital position, the total of Ram here, the credit side is 1,12,000. The Robert credit side total is 80,000. So from 1,12,000, if we deduct 16,000, 8,000, 17,500, the difference amount is, the balance is 70,400. From 80,000, if we deduct 16,000, 8,000, 11,200, the balance amount is 44,800. So, Ram has to be given 70,400. Robert has to be settled 44,800 by the firm. This is the due of the firm towards Ram. This is the due of the firm towards Robert. Okay. In this trial, we have to prepare the capital account. The red indicates the deficiency treatment as well as the balance of the solvent partner. Then bank account. Bank account, there is no balance in the bank account. Assets realized is 1,24,000. Then Raghu brings capital amount to the cash to the extent of 3,200. Ram brings the realization loss rupees 16,000 rupees. Robert brings cash 16,000 rupees for the realization loss. So the total cash that firm has is 1,59,200 rupees. This is assets realized. This is Raghu's cash. This is Raghu's Ram cash and Robert cash. Okay. So they bring bank account data to Ram's capital 3,000. That means they bring cash or through bank. Okay. So 3,200 Raghu brings, 16,000 Ram brings and 16,000 Robert brings. Then realization expenses. The firm met the realization expenses of 4,000 rupees. They settled sundry creditors 40,000 rupees. Then they paid Ram 70,400 and Robert 44,800. Naturally, the bank account will be tallied and closed. Okay. Here we have to first how much amount the company, the firm has, that we have to be calculated. Okay. In this problem, there is no opening balance. So, assets realized, the cash that is brought by the partners. Even though Raghu is an insolvent partner, he brings cash to the extent of 3,200. This is the amount which is brought by the solvent partner for the realization loss, Garner versus Murray rule, and then expenses. This is the expenses, and this is the sundry creditors settlement, and then this is the settlement of the solvent partner. Okay. So the balance is tallied. This is the method to close the accounts in the case of the solvent partner insolvency. Okay.